Welcome to Investors Insights. My name is Greg Powell, President and CEO of Five Plan Partners, and I am joined by my distinguished colleagues on the Portfolio Strategies team here at Five Plan Partners, Bobby Norman, Trey Booth, and Ty Miller. I always look forward to Monday mornings early to have debate, discussion in regards to markets and economy, and as well as to discuss ways we can help our clients' lives be better, richer, fuller in the strategies we apply here. Today, our topic is how soon we forget. I thought it was a great topic because so often in the current situations of news media and things that are being said out there, we forget where we've come from. Bobby, if it's okay, we're going to start off with you. You talked about consumer confidence and consumer debt. As the news media is pouring different topics out there, I thought you had some great points. So if you discuss those, please.
Yeah, there's a lot going on this week with a lot of important economic reports coming out, including consumer confidence, which is what we're watching carefully as tariffs continue to be a hot topic of conversation. So I want to share two charts of what we're looking at around the consumer. First, we are starting to hear from clients that their yield on their bank savings accounts are going down. You can see in this first chart that peak yields and income from money market funds have come down since the peak in August of last year, but they're still high. As you can see in this chart that goes back to 1990, we view this as a small blemish on consumption moving forward, but it's a risk to be mindful of as a future federal rates cut materialize, something that Trey's going to talk about in a minute. But if you're unhappy with the income from your bank savings account, give us a call. There are different options that we can discuss. So even with passive income coming down, though, the consumer is still looking really good, which should continue to support consumer spending, the economy, and the markets. Record high credit card debt seems to kind of garner all the attention when it comes to the U.S. consumer, but few realize just how solid their balance sheets are. As you can see in this next chart, debt service payments as a percentage of disposable income are running below the 2010s average with data through the Q1 of this year. So household balance sheets are far less levered today than they were in the 2000s, in large part due to the deleveraging that exhibited through the 2010s. So this isn't to say that the consumer will be completely immune to higher prices, but recent improvements on the labor front, especially with the tariffs staying in place for the foreseeable future. So consumer spending drives the economy, is a key driver of equity market performance. So we'll be watching the consumer reports carefully this week when they come out.
Yeah, and we've had several clients mention about rates on money market accounts, Bobby, and I thought it was great that you brought that up. Of course, I'm reminiscing here again how soon we forget, in 2008 when we saw rates drop so low. To see where we are today, it's a lot better, even with the decrease we've recently experienced. And then also from the standpoint, I know I've mentioned to all three of you that Peggy and our first mortgage rate was 10.75%. I know interest rates on mortgages were a lot lower back after coming out of COVID, but how soon we forget, where rates were. And Trey, you did a great job this morning talking about interest rates, the Fed, all the activity going on, which tied in beautifully to what Bobby just said about, consumer confidence and consumer debt. Take it from here, because I thought that was insightful and our viewers will get a lot from that.
Yeah, thanks, Greg. Yeah, so the big news this week, the Federal Reserve is going to meet, and there's been a lot of press around whether or not the Federal Reserve is going to cut rates this meeting or next meeting. And to Bobby's point, the consumer strength, the strength of the consumer lends a lot of economic data to why the Fed isn't expected to cut at this week's meeting and may not cut in September. You can see on this chart here, this shows the expectations for the market for the federal funds, how many times they're going to cut interest rates. And you can see now it's below 2 for the rest of this year. And going back to 2024, the expectations were for as many as 10. And why is that? And that's because the economy has been much stronger than we expected at that point last year. The Fed typically doesn't cut rates into a strong economy. And so, Bobby went over where credit card debt is now, but I'm going to show two charts that I think are very important, especially coming out of the summer travel season. You can see here, this first chart shows the 7-day average of TSA checkpoints. We are at an all-time high for domestic air travel in the U.S., so that shows a strong consumer. But that's just those that are flying. What about those that are driving? You can see on this next chart, this is total vehicle miles driven. Again, an all-time high. You see that big COVID dip, but we've more than recovered. So the U.S. consumer is not only spending, it's getting out there and traveling. So that shows some strength, and which kind of goes against the need necessarily for a Fed rate cut. Bobby's point about money market yield, what Bobby showed is that the consumer was bringing in $25 billion or is bringing in $25 billion a month just from interest. Someone's interest expense is someone else's interest income. And so that interest income is coming to consumers that have a high propensity to spend that interest income. And so that does buoy the economy. In addition, when we're looking at where the federal funds rate, we like to look at market indicators in addition to economic indicators. You can see on this chart, the orange line is the effective federal funds rate. That's the interest rate that the Federal Reserve announces and really has the most impact on. The purple line is the 2-year Treasury. And what that is, that's investors' expectations of where interest rates will be on average over the next 2 years. And you can see there's a slight difference, not much. And so the market's really not pricing in a lot of Fed cuts over the next 2 years, much less over the next 2 months. And so something that we're watching closely, because you have this talk about interest rates, the Fed must act now. And it reminded me of a great quote that just because something is inevitable doesn't mean that it's imminent. Yes, the Fed will eventually have to cut rates. Yes, rates are too high for current inflationary environment, but that doesn't mean that that the cut is imminent, that they're going to cut now. They don't have to cut now. Yes, they will eventually have to cut. Yes, interest rates will eventually have to come lower, but that doesn't mean that it's imminent. And that's the tricky part about predicting the future. Is you not only do you have to get the future right, you got to get the timing right. And so it's best to be humble and remember that when looking out into the future, you don't have not just the direction, but the when is also important. And right now, the when doesn't feel imminent.
Right. And I want to go back because I love this discussion. I want to go back to that 10 3/4 mortgage rate. So back in the 70s, one of the mistakes the Fed made in the late 70s is that they lowered interest rates too fast and inflation took off. You agree with me on that?
Right. I mean, you saw that last year. The Fed cut rates and we saw mortgage rates go up. That's saying that the Fed, they were offsides last year cutting rates. And so I think, it's very important to watch the market indicators over just the news cycle.
Yeah. And you brought up is some people or news media out there saying the Fed should cut rates. At this point, things are working, and very positive news, as evident by what Bobby brought into the picture here as well. And then Ty, our clients constantly having discussions about tariffs. That's still a big topic. It was a big topic this past week, and the impact on the tariffs or what's going on there. So from the standpoint of update us here, because I know last week, what we have, Japan, Philippines, European Union. Yeah, so talk about that.
Yeah, so kind of looking back or looking back at the week that was, we did get some significant tariff trade agreements. That's important because August 1st, this Friday, is the deadline for the tariff deals that were announced back in April to take effect. And so if you don't have a trade deal in place, the thought is that they will go into effect at the rate that was established back in April. Now, keep in mind that we do have kind of a back and forth with a court of appeals going in place as well regarding these tariffs. But that is essentially the thought. So that's why you're getting this incentive of countries starting to negotiate. And so to your point, we got to deal with the Philippines. The proposed rate was 20% back in April. They settled for 19%. So nothing dramatic there, kind of what was expected at the time. Japan did a little bit better, of course. Back in April, it was around 25%. They settled for around 15%. The EU, similar story, settling around 15%. The interesting part is you take a look at this chart, the average U.S. import tariff rate. So back in April, when we announced roughly $650 billion of tariffs, that rate for every country across the board, the average was right around 22%, 21.6%. Right now, the current projected rate after a lot of these deals have taken place is about 13.5%. significantly less. That is very impactful, and that's why I think you're seeing the market take these things in stride. If you check out this chart, keep in mind, in January, we started at basically zero of tariffs. April 9th, we're at 650 billion. And then it comes down, and now we're around the 370 billion mark. Still a lot of tariffs in place, but it's really, how do you see glass half full, right? Did we start at zero and now we're at 370? Or did we go from zero and we topped out at 650 and we brought it down to 370? So that's where, you're trying to just take perspective of things. So there still are more tariffs going in place, still higher than it was before the tariff announcement in April. It's just not as bad as the market was thinking, or not as impactful, I should say, as the market was thinking. So that's kind of where we're at right now. And I'm sure there will be some more deals trying to get rushed in before the August 1st deadline here on Friday. But also another announcement that we're looking forward to this week is the quarterly refunding announcement. Now, this is
very important
because we recently increased the debt ceiling. We have not issued debt as a country for the entire year. We increased the debt ceiling as part of the One Big Beautiful Bill. And now the Treasury is going to start issuing debt again. When they issue debt, that takes money out of the system because people are spending their money to buy that debt, and the Treasury receives those funds. So we went from a liquidity, kind of surplus to now what will be a liquidity drain. The important thing is, how are they going to do this? They have a couple different options. They can certainly, and this will be out on Wednesday, but they're going to talk about maybe issuing some more short-term debt, which is what we would like to see to kind of keep the long-term rates maybe where they're at right now and not have a significant tick up higher. And so those are things that we're looking for, not necessarily that we know the announcement's coming, we know they're going to issue debt, but how are they going to do it in an effective manner to not hurry this liquidity drain along and really impact things. So big announcement that probably is flying a little under the radar with all the talk of, is Jay Powell here or is he leaving? The Treasury, the quarterly refunding announcement is going to be the most important thing we look at this week on the Fed side.
Yeah, no, it's all good insight, and all of this is tied together. And throughout this year, we've said just because something becomes a headline, case in point, the tariffs, you need to watch it. We need to navigate through it. It doesn't mean just because it's a headline, it's going to happen. And so these negotiations take time. And so you're right. We've seen certain things work out far better than what was originally projected. So with that, folks, we'll stick to our theme today, how soon we forget. And please know that in these vlogs, we want to remind you about the historical data, the present, and also how things could happen as we look forward down the road. We are analyzing your portfolios in relation to your financial blueprints, and we will keep you updated as things continue to develop. It's hard to believe that this Friday is August 1st. And just know that the year is moving fast. We'll continue to give you information on our vlogs like this, our social media, Twitter, Facebook, LinkedIn, our podcast, our YouTube. We're very excited about additional information we're going to start providing you as the weeks move forward. We hope you have a great last week of July and as we go into the month of August. And just know that here every day, we want to make sure that we're striving to help you and all our clients have a better, richer, fuller life. We thank you. Take care.